Investor's Guide, where we guide you and help you on how you can make your money work for you. Over the last few episodes, we've been talking specifically about debt funds, the different categories and how they fit into your portfolio. Today, we are going to speak specifically about the short-term duration funds, how these funds work and how they really fit into your portfolio. Joining me on the show is Feroze Azeez of Anand Rathi Wealth Management. Feroze, thank you so much for joining us on Investor's Guide. So let's talk about the short-term duration funds. If you can first take us through how they really work, what is the strategy that fund managers use as far as this category of funds are concerned?
In the several categories of the debt funds, short-term funds, short-term duration or short duration funds, as they call, have a strategy of buying bonds which have a maturity of about 1 to 3 years and a duration also between 1 and 3 years, which implies that the fund manager buys bonds where the weighted average cash flow which the bonds give is between 1 and 3 years. So why is this very important? Because this determines the risk it carries on the change of interest. If the interests go up, the fund's value falls and vice versa. So lesser this number, lesser is the interest rate risk. So for this specific category, the SEBI regulation says that the fund manager needs to have a bond portfolio which ranges between 1 to 3 years of modified duration, which implies all the bonds as an average will not exceed 3 years and will not be lower than 1 year. So that's the basic strategy of the fund manager.
Right. So as far as choosing this kind of this category of fund is concerned, if you can give us a sense of what are the kind of returns that we're looking at and who should really opt for this category of funds in terms of the kind of time horizon, in terms of one's risk appetite rather, how should one go about choosing?
See, since SEBI has very categorically specified the objective of each of these subsections, here the period of investing ideally should be between 1 and 3 years. So everyone can invest depending on the money and the corpus which they have accumulated. If their goal is 1 year away and within 3 years, this could be a very good category to be in because it marries the investor objective and the fund manager objective, point one. Point two, currently there are about 25 schemes in this category and the average period of all these funds put together is 2.2 years. So that's the current modified duration of this category. And it has about 1,16,000 crores invested. Coming to the last point, which you wanted some clarity on the return expectation, last 1 year return has been 8% odd. But I think going forward, expecting 6 to 6.5% on the higher side and 5.5% on the lower side from this category is a fair expectation for investors who want to park their money or invest their money for time frames as equal to 2 years plus or minus 1 year.
All right. And just wanted you to elaborate a little bit as far as the risk aspects of this category are concerned, because, there is this notion or this misconception very often as far as debt funds are concerned that they're much lower risk and one doesn't have to worry about the risks in this category. But it doesn't come without its set of risks. Like you were pointing out, it has the interest rate risks, credit risks in some cases. If you can just elaborate on that a little bit.
When it comes to credit risk, the papers the overall 25 schemes hold is about 92% in AAA and sovereign. Sovereign, by which you mean government papers. So 92% of it is very, very safe. 8% of it is put into AA papers, which are still good quality. So this category currently, as the schemes are poised, all the 25 of them, if you choose them rightly, they are very low on credit risk. As they have invested in sovereign government papers, state government papers, AAA rated large companies, which may end up being the nifty top 50 companies of the country. So the credit risk is reasonably low. Only 7 to 8% is subject to some degree of credit risk, which is also very well managed by the fund manager. Then coming to the interest rate risk. If interest rates were to go up by 1%, during your holding period, the return would not be 6.5%, but it would be 4%. So the interest rate risk is low enough to keep your capital very safe If you're unlucky, then the return could range at 4, 4.5. If you're lucky, it could be 7. This is the kind of range of return one could expect if he wisely chooses 2-3 schemes from this category.
Okay, so given the current environment that we are in with respect to interest rates, we have been seeing interest rates coming down, ever since the last few months and before that as well. And it is expected to fall further even going forward. What would be the things that an investor needs to be aware about while choosing this particular category and fitting it into one's portfolio?
When it comes to interest rates are different for different time frames. That's one thing which an investor always needs to understand. A 3-year interest rate of Government of India will be at 4.6%, but a 10-year paper of Government of India, the same issuer, central government or RBI, would be 5.8%. So the interest rates of 1 to 3 year period has already come down. So expecting further reduction on the short end or the shorter papers seems unfair or unreasonable. So you would be disappointed if you expected capital gain, extra return because of interest rates fall. So these schemes will not give you a very big positive surprise and may not give you a negative surprise. So to answer your pointed question, anybody choosing the scheme today, I would say these are very, very safe and can be included in one's portfolio to the extent of 10 to 15%, depending on the liquidity one needs on his personal finance.
Right. And finally, Feroze, if you can also take us through the tax impact as far as these funds, debt funds in general as well, are concerned.
See, taxation is one of the most important things, Amni. So, very apt question. Because tax and death is the only two certainties, as the proverb goes. So taxation on debt schemes is very attractive after they finish a 3-year holding period, which is 1,097 days of holding. Once you supersede that holding period, the taxation could be 8 to 10% on the gain which you made, because it is 20% with indexation. So 20% with indexation, by which I mean to the extent of inflation, you get a tax discount. After the discount, you may end up paying 10% tax, by which you mean if you've earned 50 rupees in a scheme, you may end up paying 5 rupees as the tax and 45 can be pocketed. The holding period has to supersede 3 years for the tax efficiency to kick in. If it is less than 3 years, then it will be depending on the tax slab which you currently fall in.
All right, Feroze, we'll leave it there. Thank you so much for joining us with all of that perspective as far as the short-term duration funds are concerned. We hope for our viewers that this has helped you understand what this category means. And we're going to continue with our discussion on the next episode and talk and focus on the ultra short-term duration funds. Again, an extremely important category, especially for short-term investments. We'll talk about that on the next episode. Until then, thank you so much for watching.